This is the morning brief from the Economic Times.
It's the biggest edtech company in the world. And at $22 billion, the most valued startup in the country by a mile, that is still being run by a homegrown entrepreneur.
We need to put in context Byju's mind-boggling success with user growth and funding. Byju started raising serious amount of money from 2015, and that is when it did Series B round of about 10 million. From then, it raised nearly $5 billion in the past 7 years. So almost every quarter they raised money at phenomenal valuations. And the growth, as we know, was largely driven by two set of activities. One is the high ticket acquisitions that they have done time to time. So including the $1 billion buyout of Akash, which is under spotlight right now. And the other driver has been marketing. We know, from the very early on, Khan was one of the brand ambassador. Yeah. And from sponsoring Indian cricket team to the FIFA World Cup, it has been bold and aggressive when it comes to marketing.
My colleague Manu, editor of Internet Economy and Venture Capital at ET Prime, has been keeping a close tab on Byju's for several years now.
So this growth, and of course, the investors kept pumping in money because each time they saw impressive growth in terms of user base and the revenue that is kicking in. So this growth was in some sense gravity defying, and there is some problem with that kind of growth.
In other words, what Manu is saying, whatever goes up also has to come down. And if one grows at the speed with which Byju's has, then the fall can potentially be quite hard. And that is already playing out with a spate of negative news flows in the recent weeks.
Byju's is giving onlookers chills, from hundreds being fired from recently acquired units to a delay in $1 billion payment. The next chapter in Byju's success story is a cautionary tale, and the edtech giant has been on a warpath of acquisitions which are now proving to be a pain point. News of delayed payments set off alarms and cash flow issues from the Bangalore-based startup. Reports indicate that Byju's asked for extending the deadline for making parts of the payments for a $1 billion acquisition of Akash that it announced a year ago. Last week alone, units acquired by Byju's have fired over 1,500 employees as per media reports. The company, however, reiterates that this number is as low as 500.
My concerns are, one, education is mainstream and tuition is good to have, and that model is flipping, where it seems that tuition is becoming a must-have and tuition is being positioned as something which will move education in the future. The second element is in terms of the gravity of challenges which are being put out in the marketplace in the last year and a half in the social media, in the public domain, are probably not being addressed with adequacy. And the third element is that if you are doing something positive in some other part of the world like acquisitions, what happens to your employees in the country of origin? Look at June 2022, the Deloitte situation. Then you look at 6 months ago, December 2021, BBC had put out an extremely strong article on their concerns about Byju's. And then in August 2021, there were FIRs filed on misleading people, and also that's one side. But then you go to these platforms like Mouthshut and Glassdoor and Quora, and you see the employees as well as the customers giving a 4-star rating, and 68 to 70% of the employees saying that it is, a place where everybody should work with and all. They appear to be very contradicting.
If Stanford alum Rishi Kapal, an author of crime and startup sagas, also an academic, employability innovation specialist, and faculty member of Vijaybhoomi University, is searching for questions, imagine the flutter in the entire startup ecosystem. It's Tuesday, 5th of July. From the Economic Times, I'm your host, Arijit Barman, and you're listening to What's Going On at Byju's on the Morning Brief. But courting controversies are hardly new for a company like Byju's.
As far as Byju's are concerned, there are two sets of problem which has always been talked about. So one is the aggressive sales tactics. We all know the overselling, the high user dissatisfaction, which spills over all the social media platforms, and of course, the quick cancellation that happens after that, after enrolling for their paid courses. But many a time there were problems about payments not stopping even after cancellation. And the other was on very high targets given to the salespeople, and they were going great lengths to achieve their targets, and that created sort of a work culture problem. And when we say that, we need to keep in mind the fact that Byju's is an extremely sales-driven organization, and its current status as the largest, the highest valued Indian startup, the largest edtech, and that is largely a success of this salesmanship that was exemplified by the founder Byju Ravindran himself.
Being obsessed about sales and possibly indulging in sharp business practices is one thing, but now matters are evidently getting far, far more serious.
And now a third area of focus is coming as far as Byju's is concerned. That's about the managing its own finances. So the news of audit-related troubles and non-payment, etc. So the future of Byju's depends on how well it navigates this challenge, and which is very critical to its cash management and finances. And I think, given they raised $5 billion, they can absorb some of these setbacks. Also, a lot is riding on Byju's for some of the big investors such as Sequoia and Tiger Global.
Let's start with the financial disclosures and Byju's auditor Deloitte, a Big Four tax and audit firm. For the last 2 years, that is fiscal year 2021 and 2022, Byju's yet to file its audited financial results. To be fair, private companies often delay filing their financials. But 15 months have passed since financial year 2021 ended, and that's enough time to raise several eyebrows. That's not all. This month itself, there have been news reports that Deloitte is refusing to sign off on the 2021 numbers, uncomfortable with the accounting practices and alleged business dealings of Byju's. And that is significant because
the challenge always happens is that when marketing promises, the delivery system has to fulfill that promise. And I believe in the larger ecosystem, that gap of promise versus fulfillment is increasing, and that is why the dissatisfaction starts to seep in.
But hey, where is Deloitte in all this?
So whatever I have read about Deloitte not signing it, and Byju's has come back and said that no, it is not Deloitte not signing. It is just that the auditing bandwidth was not there. And there was a lot of consolidation and mergers and acquisitions happening. So we had to take a lot of data. Now, between the two, there has to be a referee, and the referee has to be the regulator to say nothing doing. If somebody has to file the returns, they have to file the returns. The company itself is refuting their own auditor to say that, it's like our auditor is not signing because we did not have the information at the right time. And the auditor is keeping quiet about it. And Deloitte officially has not gone on record and said that we are hesitant in signing.
The radio silence from the auditor is indeed making matters more suspicious, to say the least.
Everybody is silent about it, and silence most of the times in the parlance of compliances is not taken very favorably. So the key concern is that when Byju's gives an opinion about a report in the open that the auditor is not signing, the auditor is not responding. So somebody has to refute it to say, if Byju's is saying that my auditor is not signing because we were in the mix of consolidations, mergers and acquisitions, the auditor is silent. So the two voices are not being spoken in unison.
Like several cases, Byju's high-profile board and backers like Silver Lake, Sofina, Qatar Investment Authority, Tiger Global, BlackRock, CPPIB, Naspers, Sequoia, among others, have also been silent thus far. An important disclosure here, Times Internet, part of BCCL that publishes the Economic Times, is also an investor in Byju's.
All the investments coming from US and most of the heavyweights, the acquisitions which are being done by Byju's, when they acquired Epic, when they acquired Osmo, when they acquired Tinker, they are also happening in the US. So is it that the board also knows that the larger play will happen in the country from where the money is coming, and hence keep on ignoring what's happening in India?
But what's happening in India is no less confounding. Byju's bought Akash Educational Services, a test prep company, in June of 2021 for $1 billion in cash and stock, in what was the biggest deal in the industry then. Akash and its investors, that's mainly Blackstone, wanted a staggered payout. But now, Byju's wants to defer its installments by at least 60 days as per some reports. Yet another set of reports claim it is parallelly pursuing two large acquisitions in US, that of 2U and Cheggs. Both would be potentially over $1 billion buyouts, and that begs the question: if past dues are not settled, would you still go ahead and splurge on shopping?
In the last 15 days, I think there is a news of around 2,000 plus people which Byju's has to let go, right? So now you cannot connect the dots to say that there's an Indian company which was acquired, but the money is being deferred. There are 2,000 plus people, Indian employees, who probably will not have a job because Byju says that they need to consolidate operations. And on the other side, there is a news of an acquisition in US. So when a founder gets funded from a VC fund, say $2 billion, and the $2 billion are tranched by the investor and the founder that this will be used for acquisition, at that point of time, it is the founder's prerogative to decide with the investor whether the existing creditors can be settled with that money or not. It seems that the agreement for the money which came in recently was purely for an acquisition which could not have been used in any heads, and that's a standard practice in the industry.
But Byju's have also been charged with creative accounting practices by several of its critics for booking 55 to 60% of even its multi-year subscriptions upfront. Then again, to be fair, this is not unique to edtech or Byju's.
You look at India in the telecom sector, is like 92 to 90% of our subscriptions are prepaid. And there is always this conversation that are they actual subscriptions or these are activated cards lying with the distributors and retailers but not used. So this is how creative accounting has earlier also been questioned in the country, that are you booking a service which has been used or are you booking a service which has just been activated?
In edtech, they call it income sharing agreements or ISAs. How does it work? So imagine you enroll for a course, but the course is given to you for free. But after you complete the course, you land up with a 3 lakh rupee job. But now that you've been employed, you have to pay the course fee of say $1 lakh back to the course provider. Call it a train and hire model, where you are being trained for free but will have to share your income once hired. Financial intermediaries like NBFCs and banks also get into the mix at this point to help ease the burden of payments.
Technically, if I owe the content provider or the training company 1 lakh rupees, the company say charges me 10,000 rupees per month over 10 months. And that is where early booking of revenue started, to say that my order booking. So there is a difference between order booking and there is a difference between net sales. So if I owe you 1 lakh rupees, you have booked an order for 1 lakh, but my net sales might be happening over 10 months time. And that is where in between these loan elements came into picture. When you look at creative accounting, that maybe the subscription has been, say, taken for 50,000 rupees, but it has not been used. But I've already booked that 50,000 rupees in my revenue, because in between I have put a person who's basically my partner, who's giving loans to the parents and they are going to recover the loans from the parents, and I've taken a back-to-back assurance from them. So for all practical purposes, if you ask a layman that when should you book revenues, you book revenues when you actually get those revenues or you actually collect those revenues. But I think I'm not very clear about the fact that the numbers which come out are actually orders booked where services are still to be utilized, or the money has been paid up in advance by the loan providing companies and they're recovering the loan from the parents.
It gets further muddled once you consider Byju's makes a lion's share of its total income of around 65 to 70% by selling hardware, that is Byju's tablets and SD cards to children in the K-12 segment, from kindergarten to grade 12, based on the last available financial data from 2 years ago. Put simply, unlike other edtech players, which largely sell only software products like apps and online classes, Byju's has always bundled hardware with their software product.
Hardware is a one-time asset.
Yeah.
And it is like any other mobile phone or a laptop or a tablet, which basically is a trading business. You don't manufacture your own laptops. You basically bring it from somewhere, you brand it, and you send it out. But it's about who's accepting that model. So if the investors believe that 60% of the revenue coming from tablet sale is okay, and it is called like a golden handcuff, where if the tablet is inside the product or the service will definitely be inside, it's a model. Maybe the model is working more because of the reason that the people who are being given these tablets and these softwares, for them it is too aspirational to a level that they are actually compromising on their other expenses and taking 50,000 to 1 lakh rupees loan even to get these services from Byju. But in August 2021, there was an FIR filed against Byju's that the curriculum for the public services exams that they had put up was actually misleading.
Equally distressing is the web of financial arrangements like first loss default guarantees, or FLDGs, or 100% default guarantees that Byju's allegedly get into with several of its lending partners that, on the face of it, may appear great gestures but are problematic for a variety of reasons, including regulatory ambivalence. Byju's spokesperson claim the company offers FLDG of less than 3.5%, but finance industry executives counter-argue by saying the figure varies from lender to lender and in reality is much higher.
What happens in the first loss default guarantee is the fact that how much is the default, and is the default actually getting covered by the parent company or not. So while it has been put out as a positive in which a company backs a vendor or a service provider or a financial provider, but the defaults probably are not out in the market to say how much default happened and how much did Byju's cover for that matter. So I think people are still reading between the lines to say that is really a favor being done to the service providers with the FDLG, or anyway there is a mechanism in which the money is getting recovered. So that is where it is completely in a stealth. Byju's went on record and mentioned that 90% of the legal cases which happened in the consumer court have been settled by us for that matter. That is the perspective where FLDGs were discussed.
Schemes like 100% money backs or first loss default guarantees is that it makes a company like Byju's a permanent seeker of capital. Like it's been packaging its trade receivables through pass-through certificates, securitizing them only to sell down to external investors.
The challenge of the existing popular product itself is coming under a lot of conversations from multiple parties. And if there is a byproduct which is going into getting converted into securities and getting into the markets for people to acquire, I think again it is the regulator whose lens needs to be very, very sharp over there.
It's a lot like the refund scheme, but as a recent BBC report highlighted, there is a lot of difference between promise and delivery.
Parental anger against Byju's is growing, at least from some of its customers. Their allegations: pushy salespeople selling expensive courses to parents, difficulty in getting refunds, and a lack of customer support after a sale is made. In online forums, scores of positive reviews and happy parents, but also hundreds of complaints from unhappy customers. Byju's denies all these allegations, but there have been at least 3 cases where Indian consumer courts have ordered Byju's to even pay damages in disputes related to refunds and deficiency of services.
There's always a fine line between a guarantee and an assurance, right?
Companies which provide guarantees would always be at risk. So most of the companies have walked away from guarantees just because people use and then one day make up their mind that I just do not use this service. So I think there's a very, very thin line. Assurances are always in terms of the onus being equally on the service provider as much as the service seeker. And I believe that a company would be legitimate and will be able to sustain its businesses by assurances, not by giving blanket guarantees. And is the word guarantees more being used by the sales team, or it is actually the organization which is saying that you give guarantees but ultimately we will execute assurances? Is again, our word against somebody else's.
My colleague Manu sums up this core corporate philosophy rather well.
What's the core problem? Where is the inherent problem? One underlying reason that becomes increasingly clear is aggression. But aggression is good as far as startups are concerned. The aggression is good. It's necessary in scaling up startups, but it needs to be reined in at some point in time.
So do you milk a student to the maximum or build a long-term relationship over the years?
Some companies look at a business model to say that I've acquired 100 students and I've got a 5-year roadmap for these students. So I will ensure that at least 60 to 70% of the students I can retain over a period of a 5-year life cycle. So that is what we call as a customer life cycle. Good edtech companies that I've seen always have believed in almost more than half of their client base to be retained for a customer life cycle value. But in terms of having a new customer every day, accountability also does not come up in the long run.
Rishi feels Byju's realized it much earlier than its peers that an omni-channel model, that is a combination of online classes with physical tuitions, work best as fears of COVID-19 pandemic has started to ebb.
At least the Byju's marketing machinery has those deep insights in the marketplace that they should start opening physical centers as soon as COVID recedes. So that is why Byju's tuitions are now becoming physical centers. And that is probably also something as a business model which will be more in their favor, that they've told people that we are not just there online, we are also going to be available offline. And that is a credit I can give to the company in terms of being really smart in understanding how the wave is changing.
But the onus is on players like Byju's to prove their commitment and accountability.
Deeper question there is about the product. So, what is the real effectiveness of online tutoring championed by Byju's, and what is the real outcome? So, what is the edtech's commitment to educational outcome? That's a larger question that need to be discussed.
Following China's crackdown on edtech, parliamentarians in India too are becoming deeply concerned.
As we know, already edtech and primarily Byju's are facing accusations over overselling, and which forced the government to come up with an advisory in December. And that advisory reads, do not trust the success stories of edtech companies without proper checks. And they may be a trap. That's what the government advisory said. So, and we know Karthi Chidambaram's remarks in the parliament about the predatory marketing, auto debiting, etc. So he covertly mentioned Byju's in that speech as well. So this practice has already become a topic of discussion, and there is a demand for strong monitoring of edtech sector. And as a result, now there is a self-regulation code that the edtechs have come up with, and that came just 3 months ago. So now we will need to see whether they are enough.
Responding to ET's detailed questionnaire, Byju spokesperson said, our fundraising efforts are on track and majority of the $800 million has already been received. The balance is also expected soon. Our payments to Akash are closed and the audited financial results are going to be announced in the next 10 days. Talking about job cuts, She further added, in order to reduce redundancies across our organization after multiple acquisitions, we had to let go of nearly 1% of our 50,000 plus strong workforce. This retrenchment was a result of a strategic decision to improve business efficiencies through Byju's and its group companies. Byju's remains a net hirer. With 50,000 plus employees and growing, we take immense pride in our role as India's largest job creator among startups. Byju's continues to hire across levels for various businesses, departments, and functions. My take. The issues are diverse, as are the allegations, and so are the regulators concerned. Financial disclosures, alleged accounting discrepancies fall under the Ministry of Corporate Affairs. Overall education comes under another ministry and referee. So if a company like Byju's is expected to perform in all domains of ethics, education, and finance, then regulators cannot work in silos. But do we have such a framework in this country that still remains smitten by the number of unicorns it produces every month? So to me, who keeps a tab on edtech companies is equally important in a sector as emotive and sensitive as education. The socio-economic ramifications are humongous. Having said that, education is at the core. That's why the money is coming in, and that's why ethics are being repeatedly questioned. So the onus primarily should lie with the HRD ministry and the relevant education regulator. But then again, look at Byju's breadth of offerings, and each one would fall under different regulators. K-12 comes under CBSE, CISCE that conducts the ICSE and ISC exams. Then there's NCRT. Never mind the regional boards. Higher education is under the purview of AICTE or UGC, and test prep, well, I doubt if there is any who is overseeing them in the first place. The whole business runs on word-of-mouth success. So it's not an easy one to crack, but an essential one to start seriously thinking about. You've been listening to What's Going On at Byju's on The Morning Brief with me, your host, Arijit Barman. Producers for the episode, Bhavya Dilip Kumar from ET and Swati Joshi from Awaz. Sound editors, Rajas Nayak from ET and Soundarya Jayachandran from Awaz. Executive producers, Anupriya Bahadur and yours truly. The Morning Brief drops every Tuesday, Thursdays and Friday. If you like this episode, please make sure to share it on your social media. Thank you for listening and have a great week ahead. Do tune in to ET Play, our latest platform for all audio content, including The Morning Brief. All clips used in this episode belong to their respective owners. Credits mentioned in the description.